Welcome back to The Explainer. So here's a wild thought for you. Did you know the global bond market is actually way bigger than the global stock market? It's true. Yet, for some reason, fixed income securities get this terrible reputation for being hopelessly complex. But I'm going to let you in on a little secret today. There is barely a single concept in this whole field that doesn't run on pure, unadulterated logic. Seriously, once you grasp the underlying mechanics, you don't have to memorize a single thing. So today, we're skipping the rote memorization altogether. We're going to build a mental framework that's so rock solid, all those intimidating formulas are just going to feel like common sense. Here's our roadmap for this explainer. First, we'll cover the basic principles of bonds, then look at the different types of bonds, dive into bond valuation, figure out yield and YTM, and finally, wrap up with bond duration. All right, let's jump right into section 1. The basic principles, or as I like to call it, the DNA of fixed income.
Okay, so I want you to imagine you're just taking out a simple bank loan. Well, when a government or a giant corporation needs cash, they do something very similar. They issue a bond. Essentially, they're taking a loan from you, the investor. And if you look at the exact cash flow timeline, it makes perfect sense. At year 0, right at the start, the money leaves your pocket. That's the issue price, your initial outflow. Then, over the life of the bond, from year 1 all the way to year N, you get these periodic interest payments, which we call coupons. And finally, at maturity in year N, you get your principal handed right back to you as the redemption value. Honestly, if you can just visualize this exact timeline, you've pretty much conquered half the battle of fixed income.
Now, to really lock this timeline down, let's clearly define 3 core terms. First up is face value. This is just the nominal value of the bond, basically what you're getting repaid at maturity. Next is the coupon rate, and pay attention because this one is absolutely crucial. The coupon amount is always calculated as a percentage of the face value. It literally doesn't matter what price you paid for the bond on the open market. And third, we have time to maturity, which is exactly what it sounds like, how much time is left from today until you get that final redemption payout.
Moving on to section 2, let's look at the types of bonds and how we go about structuring those cash flows. Just by tweaking those basic cash flows we just talked about, issuers can create entirely different instruments to fit all sorts of market needs. Take zero coupon bonds, for example. Instead of giving you periodic interest, they give you a massive discount upfront and then just pay out the full face value at maturity. Then you have conventional bonds, which give you both those regular coupons and a set maturity date. And then there are perpetual bonds. These have absolutely zero maturity date. They just pay out coupons to infinity. It's kind of like a streaming subscription you can never cancel, but, in a good way because they're paying you.
Now, even within those conventional bonds, there's another layer of variation to think about. See, coupons aren't always just a static number. You can absolutely have a fixed rate, say a locked-in 8% for the next 10 years. Or you can have a variable or floating rate. This is where your coupon is actually tied to a market reference rate. A common one is SOFR, the Secured Overnight Financing Rate. You take that reference rate and add a fixed spread. So if SOFR is sitting at 5% and your fixed spread is 3%, your coupon for that period is 8%. And the beauty of this is if the market rate goes up next year, your coupon bumps up right along with it. Which brings us to section 3, bond valuation, and figuring out how to actually find the fair price.
Okay, so the multi-million-dollar question is figuring out what any of these bonds are actually worth out there on the open market. How do we find the fair price? Listen, if you take away just one fundamental rule of finance from this entire explainer, please let it be this. The value of any asset today is exactly equal to the present value of its future cash flows. That's really it. I don't care if it's real estate, a share of stock, or a bond. A bond's intrinsic fair value is simply its future coupons plus its final redemption value, discounted back to today's dollars. Let's break this down into a deeply logical 3-step process. Step 1, map out all your future cash flows. Simply ask yourself, when exactly are you getting your coupons and when are you getting that final redemption value? Step 2, determine your required rate of return. This is basically your opportunity cost. If similar bonds out there in the market, bonds with the exact same risk profile are paying 12%, well then your required rate of return is 12%. Step 3, use that 12% to mathematically discount those future cash flows back to the present day. Just as an example, a $1,000 payout a year from now, discounted at 12%, is worth about $892 today. Add up all those discounted pieces and boom, you found the fair price of the bond. And that brings us right to the compare and decide rule. See, you just calculated the intrinsic value, which is what the bond should realistically be worth. Now you look at the current market price, which is what the bond is actually trading for on the exchange right now. So if the intrinsic value you calculated is, say, 1120, but the current market price is only 1100, well, what does that mean? It means the bond is undervalued by the market. It's literally on sale. And that makes it a smart buy. All right, Section 4. Let's talk about yield and YTM and how we measure your actual return. So now that we know how to price a bond based on what we want to earn, let's completely reverse the math. Let's compare two vital ways to look at the returns you're actually generating. Your required rate of return is what you want to earn to justify taking on the risk. But your yield to maturity, or YTM, that's what you will earn. YTM is the actual annualized return you're going to lock in if you buy the bond today at its current market price and just hold on to it until the very end. Now, technically speaking, yield to maturity is the specific discount rate that perfectly equates the present value of all your future cash flows to the bond's current market price. But honestly, practically speaking, just think of it like a seesaw. If you buy a bond on sale, meaning the actual market price is lower than its fair value, your YTM actually goes up. You end up yielding a higher return than your required baseline. And logically, if the market has priced the bond perfectly fairly, your required rate of return and the YTM are going to magically equal the exact same number. And finally, Section 5, Bond Duration and Understanding Price Sensitivity. Let's wrap up this explainer by looking at risk, because up to this point, you might be thinking bonds sound like a perfectly safe, cozy investment. But what happens if interest rates in the wider economy suddenly shift? I really cannot state this inverse relationship forcefully enough. It is the absolute golden rule of fixed income. As market yields go up, existing bond prices go down. Just think about it. If you're holding a bond paying a fixed 8% and suddenly brand new bonds are issued paying 10%, your 8% bond is instantly way less attractive to everyone else. To convince anyone to actually buy it from you, you'll have to drop its price. But the critical question for any portfolio manager is exactly how much will that price drop? Well, we measure that drop using a metric called modified duration. Let's anchor this concept with a highly specific real-world calculation from our source material. Imagine you calculate a bond's modified duration and you land on the number 3.865. What does that actually mean for your money? It means that for every 1% spike in overall market yields, the price of your specific bond will drop by approximately 3.865%. It acts as a direct multiplier of your risk. Which leaves us with one final, absolutely vital question to ponder. If market yields suddenly spike out of nowhere, and you know exactly how much your bonds will fall because you calculated their duration, how do you protect your entire portfolio from the chaos? The answer lies in a highly advanced strategy known as immunization. This is where you deliberately match the duration of your assets to the duration of your future liabilities, so that any unexpected interest rate shocks essentially just cancel themselves out. It's a brilliant structural secret used by the world's top institutional investors. And honestly, with the foundational logic you've built up today, you are well on your way to mastering it yourself. Thanks so much for joining me on this explainer, and keep learning.